Welcome back, everyone. Today's video is going to be an update on gold because I've been seeing some things and having some thoughts, and I figured, there's been some questions too, so I figured I'd share what I think and what I think is moving it. So to start off, I'm not ready yet to change my standing, if you will, calls on gold, where, a few months ago I said I preferred some other things. Recently I said I think some other things would continue to outperform. Both times, I guess, partially right, but partially wrong, because I both times said I wasn't bearish gold, and it has gone down since, so the right move would have been to sell all, but I did not. So I am still there with many of you gold bulls out there, so I still have exposure, but I think that we are getting closer to the point where might be bullish again, but I don't think we're there yet. So whenever the subject of gold comes up, gold especially, the conversation normally does or should move to interest rates, or particularly real rates. So I know that, when people talk about gold, sometimes they say gold, can do well in rising rate environments. It can. But in those rising rate environments, and I'll show you what I mean in a second, it often is the real rates that matter. And I still think we're at a point where real rates in aggregate, meaning across the curve, must remain negative. Otherwise, we have issues. At the same time, I think interest rates must remain low, or else, again, we'll have issues. But as long as they're negative, which, by the way, they still are, basically across the curve, then we're fine. Well, not fine, but it's not, you can make an argument that things could get slightly better, slightly worse. Still up for debate, the general direction. But if they were positive, then things start getting very troublesome very quickly. So I think both of those conditions must remain in effect based on just the math of the situation, if you will. But that doesn't mean that gold can only go up from here. Now, I'll compare this with gold in a second, but in this chart, if you will, remember, there's people that have argued that gold will go up or can go up a lot in rising rate environments, and that is very true. I want to focus in on the 70s here. You look and real rates were going up, inflation going up more, and then in blue, look at in blue again. Just really focus on the blue line here, because that is real rates. So even though interest rates were going up, real rates were going lower and lower. And that is exceptionally relevant, because burn that image into your mind of the blue line in the 70s. Now take a look at this. Now this is the price of gold over approximately the same period. And you can really see how, as the real rates are going lower, gold loves it. And by the way, this is inflation adjusted, or the variant of inflation adjusted that the chart provides. So as real rates are going lower and further negative, gold really loves that. But as real rates are going the other way, which they have been recently, gold does not like that. Now the other thing is, we've seen some stimulus recently in different regions, and I just don't think that that is too relevant for gold, because, in the grand scheme of things, it may cause inflation, it may also cause growth, and those may net out to real rates going positive, which is worse for gold, and maybe the yield curve gets capped and the inflation outpaces it, in which case it's positive for gold. But as of yet, we can't really say. Now the other thing is, I want to clarify a few things. Gold is different from most other commodities. And so I figured I would kind of lay out the situation as I see it, in terms of, who needs what. We talk about what different either institutions, asset classes, or who targets what. And for gold, if you're a gold bull, you want either inflation, let's call it stagflation in this case, or deflation. But growth, not good, because growth means real rates go higher versus, what governments are looking for. It's inflation and growth because they need to inflate the way out of the debt. Bonds, they need deflation. Other commodities are different from gold. They don't need, well, they're not, it's very bad if there's deflation, but it's good if there's growth and inflation. So one of the recent themes, both inside of and outside of the commodity complex, has been the market looking at inflation. And I think that what would make gold start outperforming is when we shift from inflation in terms of, coming out of the pandemic, a boom here, healthy economy, breaking out of the deflationary spiral with growth, inflation. If we switched from that to stagflation in terms of growth kind of fading, whereas the input prices keep rising, I think that is the type of transition that that would be bullish for gold. But it doesn't have to be that. It could, even if we switch to back to deflationary, as long as the growth element shifts away from, better and better growth to never mind, back to stuck again, then I think in either of those scenarios, I think gold starts outperforming. And I do think that we're approaching a point where the pace of growth is starting to be, there's some expectations there that may not be the simplest to achieve. And the other thing that could be bullish for gold is yield curve control. So I know a lot of people are talking about how, yield curve control is inevitable, and probably is. When it starts, though, is another debate. But how yield curve control is very bullish for gold, and it really will depend how it's implemented, I think, because if you had to pick a number of what yield makes sense to cap it, if you will, to me, I think like 2%, if they were going to implement it. I mean, that's higher than some would like, but in other ways reasonable and kind of where it might make sense. We're still a ways away from that. You look and it went from 0.5% to 1.5%, and that caused a big move in a lot of things. 2% is still a ways away by that thing. I mean, it could be tomorrow. I mean, the way the bonds have been moving recently, but you never know. But the other thing is, remember that, the funding for the government isn't all 10-year bonds. In fact, it is heavily weighted to the short end of the curves, the rolling at 1 year, 30-day, whatever, where the rates are still zero. So it's hard to judge at what yield would things be a problem issue, because we don't know you don't know exactly how it's weighted and how things move, and it's a live market. So, it's probably could be higher than you'd expect. And I mean, I guess even 2% in terms of nominal yield is probably higher than sustainable, unless there's more than that in inflation. So for those reasons, and the reason that I think there's still potential for higher yields, I think gold, I'm starting to look at the companies again, and I'm refilling the watch list. Honestly, if I had to bet, I'd probably re-enter or rebuy some of the names that I liked before, because I still like them, and most of the sector has moved down together, really. And so I'm watching them again, and I think we're getting close, but still, there's still some upside in yields potentially. And I think if yields got to a point where real yields were looking like they're positive or very close, then I would be more anxious, if you will, to enter the positions. So I wanted to say a few more things about yield curve control because I do think that implicitly or explicitly it's coming, and gold bulls do often focus on yield curve control as a very bullish case, which I believe it would be a bull case. I mean, everyone kind of does, but my skepticism there is, yeah, I think it would be bullish, but I'm not convinced it would be as bullish as some believe initially. And why is this? Well, if you look at how markets move, how yields move, how inflation expectations move, and this is really big. Inflation expectations, they move slowly. And so let's say yield curve control were, explicitly mentioned tomorrow as a thing. Well, maybe that's a sign that inflation expectations are going to be a bit higher. But at the same time, what's a bit? 0.1%? And so you have to look at, okay, well, what would 0.1% move up in real yields be? Well, a little bit bullish for gold. But the point is, things move gradually, and you never know when the market is going to say, when things reverse. So I don't think it's going to be, okay, yield curve control, gold to the moon. I think it's going to be yield curve control, probably a boost in gold, probably a bit of a jump. But at the same time, I think that it's going to be an environment, yield curve control environment that allows gold to run without the headwinds of higher real yields in a growth environment. So basically, if you remember this chart from before, you see gold has kind of changed a little bit because yield curve control means that growth plus yield curve control means, there's inflation that comes along with growth, but without the negative of real yields going higher, that is the problem for gold in growth environments. So with yields capped, the rising yield part of the equation would stop being a negative for gold. Maybe the financial apocalypse narrative would lose a bit of steam, but realistically, who am I kidding there? Meanwhile, on the subject of yield curve control, I just wanted to add that I think there's a number of other sectors that would also love yield curve control. Think of yield proxies, the real assets backed by cheap debt for growth, other commodities. Other commodities, by the way, they can do fine in rising real rate environments as long as there's inflation, which it generally comes in rising real rate environments. It's only gold that acts as a currency that hates positive moves in real rates. But anyway, the point being, I'm not FOMOing on gold yet. So while there are many arguments as to why the gold price should be much higher, in reality, when you look at the practical purposes for miners, the gold price is still plenty high enough. So at this point, at this price, the miners have plenty of free cash flow yields. And when people were talking about gold stocks and look at how cheap this is, they talk about the free cash flow yield in the gold stock. And that's true. They do have big free cash flow yields, which means lots of money that they could spend on either dividend or growth in terms of not declining because mining is a depleting business. Now, this is one of the reasons why recently I've been looking a lot at the drilling sector, which is one that's kind of slept through much of the move up, in my opinion. And, if gold prices can stay where they are or go higher, I think there's something to look at there. Anyway, in conclusion, I think where we are now, the gold price is still very healthy. And remember, it's plus, gold's up 32% over 2 years. So it's not like the gold companies are struggling or it's a disaster. For what to watch, I would say the most important thing to watch is real rates. And so that is what I'm doing. And again, not investment advice, but I hope that helps. I still think, if I had to guess, I would say May, as to when gold would move up, but could happen sooner. I might miss the beginning. I really don't know, but that's just my opinion. So with that, I will wish everyone a great day. Until next time, enjoy.